This video will be analyzing the Silicon Valley Bank crash. It will start off by looking at why the crash took place, the effects the bank crash had on customers, investors and depositors, and whether or not the downfall of the Silicon Valley Bank will trigger a banking crisis. Before this video begins, make sure to like and subscribe. On March 10, 2023, Silicon Valley Bank crashed. Silicon Valley Bank was a commercial bank that was the 16th largest bank in the USA. The SVB provided banking services to almost half of all U.S. venture-backed technology and life science companies. This bank operated in many countries such as Canada, China, Denmark, Germany, Ireland, Israel, Sweden and the United Kingdom. The SVB benefited greatly from the tech industry growth over the years, especially as the tech industry experienced a boom due to the pandemic and the increased need for digital services. As well as being able to borrow at low costs. The SVB assets, which included loans, tripled from $71 billion in 2019 to in March 2022 had increased to $220 billion, according to financial statements. Deposits also increased from $62 billion to $198 billion, also in between 2019 to 2022. This is because there were thousands of tech startups that placed their cash at the bank. One of the reasons why the SVB collapsed was because a few years ago, like many other banks, the SVB also bought billions of US government bonds during the era of near-zero interest rates. This may have seemed like a sensible and safe decision at the time, but recently the Federal Reserve have been increasing interest rates aggressively in order to tackle inflation. This meant that due to increase in interest rates, the bond prices fell. This meant that the SVB bond portfolio was hurt significantly. Also, because the Federal Reserve were increasing their interest rate, it meant that borrowing rates increased, and it also meant that a lot of tech startups were now using more of their cash to repay their debts. As well as at the same time they were finding it hard to raise new venture capital funding. This meant that companies were therefore forced to withdraw their deposits from the SVB in order to help fund their operations and growth. As well as this, the other reason why the SVB downfall happened so quickly was because once customers got wind of what had happened, they began to withdraw their deposits from the bank, which also contributed towards its downfall. Customers began to panic and started a bank run, after on Wednesday the bank announced that they had sold a few securities at a loss. Not to mention, they also announced that they would also be selling $2.25 billion in new shares, in order to help seal the hole in its finances. The bank's stock was also affected by this news, which dropped by 60%. Not to mention other bank shares dropped as well, as investors started to worry a repeat of the 2008 financial crisis was taking place. By Friday, trading in SVB shares were stopped and any effort to find a new buyer or to raise capital was also dropped. Not to mention, the California regulators got involved and ended up shutting the bank down and placed it in receivership under the Federal Deposit Insurance Corporation, which usually means the bank's assets are liquidated in order to pay back depositors and creditors. U.S. regulators said that all SVB customers are guaranteed their deposits, which means tech companies can continue running and paying their staff. But the intervention from the regulators is not like the 2008 financial bailout, so this means that investors in the company's stocks and bonds will not be protected. Many different banks are already showing signs of stress after the SVB downfall. As trading in First Republic Bank, FRC, and PacWest Bancorp, PACW, was temporarily halted on Monday, after shares dropped from 65% and 52% respectively. Charles Schwab, SCHW, stock also dropped down 7%. In Europe, the benchmark Stocks Europe 600 Banks Index, which tracks 42 big EU and UK banks, dropped by 5.6% in morning trade, which has been its biggest decrease since last March. Credit Suisse shares were also down by 9%. Many other banks, beside the SVB, had also experienced a huge downfall, as by the end of 2022, it has been estimated that US banks possessed up to $620 billion in unrealized losses. HSBC bought the UK arm of the SVB for £1. This helped secure the deposits of thousands of British tech companies that hold their money at this bank. Hypothetically, if SVB UK had not found a buyer, then the Bank of England would have placed them into insolvency, which would have been a major problem for UK customers. For more content like this, make sure to like and subscribe, and let me know in the comment section on what you think of the Silicon Valley Bank crash.